Good morning, I'm Richard Spears, and welcome to the Drilling and Production Outlook, a presentation of Spears & Associates. This is the June 2021 presentation of the quarterly forecast. In just a few minutes, my brother John will come up and lead us through the most recent updates to our forecast and hit the high points domestically then internationally, along with what the drivers are that he's been using. The things that I'm very encouraged about as we look around our client base, around the companies that we ourselves are invested in, is that the industry is in the process of coming back, originally in North America and very specifically in the U.S. land part, and pretty soon in the international and offshore arenas. The inflection point is upon us. And it's one of those times in the industry when it's actually becomes fun again to be in this business, because those of us who've made it through have all the opportunities in the world to grow. In fact, we've seen some of the companies that we track and some of the companies that we work with return to almost those pre-COVID levels. Here around at Spears & Associates, the big chunks of our part, which are the subscription-based revenues that we make, they are almost back to the 2019 levels. A big chunk of our business every year has been associated with support of merger and acquisition events. That has not yet returned because, as everybody who's watching today is already aware, the banks are closed, capital is not flowing into the industry to do deals, but that would be something that we would expect to see in the not too distant future. So at any rate, it's not exactly happy days are here again, but it definitely feels like in the US and Canadian markets that COVID is very rapidly getting behind us, and we are returning to where we are. In fact, as my brother and I were talking even earlier today, he said that what we're seeing isn't really a surprise. In fact, it's a fairly typical response that you would see after a very sharp downturn. But the response is muted, lack of capital, but still a fairly typical response. So here's how we're going to do this in just 15 seconds. My brother will take this seat. He will lead us through the forecast, and at the end of his presentation, which will be maybe in 90 minutes or so, then I'll rejoin my brother here, and we will take the questions that have come in. You can type them into the YouTube thing, or you can email us, or if you know my cell phone number, you can text me, and we'll try to get to as many questions as we possibly can in the last 15 minutes of that presentation. So thank you again for being clients of our firm. We are almost to celebrate our 60th year being in business, and for the entire team around the world, we appreciate your support of what we do. So I'll turn it over to my brother John, and he will take it from here.
Thank you. There we go. Thanks, Rich. I appreciate everybody joining us this morning, or if you're tuning in later, for your interest in our work. Like Richard said, this has been an interesting time. We're certainly seeing the oilfield service industry and the outlook for it improve over the past quarter. And again, a large part of that is due to in the improving supply and demand fundamentals that we see going on around the world in terms of oil demand, supply, gas demand, supply. And those improving fundamentals, of course, are supporting commodity prices, stabilizing them, and even pushing them a little bit higher. And so that in turn is helping operators in terms of lifting activity and both in terms of investment, in terms of wells being drilled, rigs being employed, and things like that. So all of those things are beginning to move in a proper direction, we'd like to think. But at the same time, it's clear that operators are doing all this in the context of maintaining capital discipline, tight capital discipline, and focusing on the kind of operational efficiencies that they want to have in order to achieve the desired returns that they seek. So with that preamble in place, let's go into the numbers and talk about what has happened over the past quarter and what we think now is unfolding ahead of us over the balance of 2021 and peeking into where we think 2022 might go. So like I said, the better outlook for the service sector is conditioned upon improving fundamentals. And by that, it's really most importantly a function of where is global oil demand and supply headed. And so this chart looks at those numbers starting back in 2019 and projected through the end of this year. So red, of course, is the production figure for global oil, and demand is the consumption number. The blue numbers show that on a global basis anyway, oil demand this year is now projected to average 97.7 million barrels a day. So that's a decent jump from last year, up about 6% over the average for last year. And the projections right now anyway are for global oil demand to rise to 101.4 million barrels a day in 2022, so up almost another 4%. One of the things I mentioned in the report that we send out is how much of a difference 3 months make in the world of oil demand forecasting, because back in March, the International Energy Agency, the Paris-based organization, was talking about how they did not think that global oil consumption would return to its 2019 level, that the number they thought had peaked and would grow this year and would grow next year, but wouldn't return to the 2019 levels and may never have returned to the 2019 levels. Well, they just came out just a few days ago with their May update, and now they're saying that in fact demand is rising rapidly, that they think it will be back to the 2019 levels by 2022, that markets are tightening, that excess inventories that had built up last year were now basically gone, and so prices were heading higher. So a real turnabout on the part of that organization, and just sort of oil forecasters writ large, about what to expect on the on how fast demand is going to might recover in response to the fact that there's vaccines out there, the fact that some of the economic restrictions that had been put in place last year with the pandemic, that those are being lifted, and so we're seeing a pretty responsive set of actions on the economic front. And of course, underlying all that is that in most of the larger economies anyway, fiscal policy and monetary policy remains very stimulative. Governments are running deficits. Central banks are keeping interest rates at rock bottom levels. And all that is pumping money into the economy, and it's finding its way into greater activity and ultimately then into demand for oil. So all this is coming together. And if you have been listening to our podcast, one of the things we've been talking about in recent weeks anyway has been a somewhat longer term look as to where global oil demand might be headed, because certainly the last several months have seen a lot of discussion, a lot of proposals being put forward, various scenarios being developed that talk about climate change initiatives and the intent to reduce fossil fuel use, to reduce CO2 emissions by switching to electric vehicles, by phasing out coal and gas in the power sector and things of that nature. And so in our podcast, we've been looking at, well, sort of what do the numbers suggest? Electric vehicles today are about 10 or 11 million of them on the road. Globally, there's roughly 1.5 billion passenger vehicles on the road globally. So it's just a tiny fraction of the marketplace. We sell on an annual basis around 100 million passenger vehicles a year globally. So when you put the numbers together, as we've talked about, it surprises folks, but to hear that for the next decade, even under some very aggressive efforts to switch to EVs, that global oil consumption will stay at or above the level that we expect to enjoy next year. So global oil demand is not softening quickly for the next several years anyway. And I think that is beginning to play into some of the support we see for higher oil prices. Clearly, investment and new field development has slowed way down, OPEC is adding barrels back to the marketplace over time, but I think folks to some degree are beginning to worry about supply availability over the longer term, in light of the fact that global oil demand is continuing to grow and is expected to hold up fairly well. So, in light of these estimates of supply and demand, anyway, our forecast regarding oil prices looks fairly modest in terms of where oil is trading today. As we record this, oil has been trading almost to WTI has been trading almost to $69 a barrel in the last several days. Our forecast is that we'll see an average price for WTI of around $65 a barrel over the balance of this year and across 2022 as well. So we're not bearish on oil prices, but we're not as bullish as what you might see in the trades going on right now. And the reason for that are a couple-fold anyway. OPEC Plus, of course, has been meeting just this week, in fact, and has reaffirmed its decision to add a couple of million barrels a day to its output over the May, June, July timeframe. And because it has been monitoring these demand numbers and sees demand growing and believes it can fit another couple million barrels a day into the marketplace, and at the same time keep prices in this $60 to $70 range that they appear to be pretty comfortable with. So, but even after that's done, OPEC Plus as a group will be left with somewhere on the order of about 7 million barrels a day of spare capacity. And the question that comes to mind then is, how long will it take for those barrels to find a home in the marketplace as demand continues to grow? So when you look at the demand growth projections that we talked about from the previous slide, for example, and apply those for the balance of this year and for 2022, it would appear to us that OPEC Plus will have sufficient capacity to supply all the incremental demand growth that one might expect to see over this 18 to 30 month time frame. So that being the case, I think it's hard to imagine that oil prices will continue to ramp up much beyond where they stand today. And that's one of the reasons why we've been cautious about forecasting where the further price growth over this coming year and a half, 2 year time frame. The other wild card that we've mentioned in the past, and I think is even more applicable today, is what's going on with regard to Iran. We're all familiar with the fact that there was a 2015 agreement under which Iran was going to, that pertained to Iran's nuclear program. When the Trump administration backed out of that agreement back in 2018, I believe, it drastically hit Iran's oil production numbers. Back before the agreement got torn up in 2018, Iran was producing about 3.8 million barrels a day. Today, it produces around 2.4 million barrels a day. So as the Iranians and the U.S. and the other global powers who are party to this nuclear agreement have gathered around the table trying to find a way to reestablish, put Humpty Dumpty back together again, as it were. The thought is that some agreement will probably be brought forward over the next, or sometime in June perhaps, and which would allow Iran to begin exporting, maybe not exporting all the barrels that it could produce, but perhaps adding as much as 500,000 barrels a day to what it is currently producing, as a sort of a show of good faith on its part, or on the part of the United States, while it monitors how well Iran is doing its side of the agreement with regard to monitoring its nuclear program. So this kind of process is working its way forward. But I think most traders in the marketplace now expect to see a fairly significant amount of additional Iranian production come into the marketplace, starting fairly quickly. And if that's the case, then that too will need to be digested by the market and probably would put on pause for some period of time anyway, further improvement in oil prices. So the amount of oil held by the OPEC plus nations still in the idle category, and the fact that Iranian production is poised to begin to increase just suggests to us that caution is the watchword when it comes to projecting oil prices, at least over the next 18 to 24 months, I think. So that's where we have settled when it comes to the price estimates that we have put in place. Now, we'll talk about what we expect to see in terms of rig activity and frac activity and so forth in the U.S. in just a few minutes, but taking those numbers and then looking at what that means for U.S. crude oil production, we see the slide right here. So this is our estimate of U.S. Crude oil production over the balance of this year. And when we average the numbers for 2021, we come in at just under 11 million barrels a day output, 10.97 to be exact, down just over 3% from the average of last year. So U.S. oil output is not changing very much over the course of 2021. And there's a couple of reasons for that, or a couple of interesting things going on, I believe. First off, it's as best we can tell, it looks as if the productivity of the new wells that we're drilling and fracking, that the well productivity is now trending flat, if not down, from the numbers that we were looking at in the latter days of 2019 and the early days of 2020. So there perhaps are several reasons for that. We may have drilled our best prospects already. It might be that some of the new frac design and operational changes in terms of wet frac sand and the like are impairing or inhibiting the maximum productivity of the wells. So they're doing a cheaper job. They're spending less money on the completion side and in order to get a well online, but it's impacting the productivity of those wells. And so I think there's those kind of things which are beginning to show up in the numbers now. And of course, as well productivity softens, it makes it harder and harder to lift overall U.S. oil production. And I think that's the case in 2021 and should continue to be a factor in next year and beyond that as well. I think our productivity numbers, our high point in our productivity numbers here in the U.S. anyway, may very well be behind us. So the other thing too that's interesting within the marketplace so far this year anyway is that while the overall U.S. numbers have been pretty flat, that's not been the case region by region. So in the first half of this year, oil output in the Permian Basin will have risen about 200,000 barrels a day relative to where it was at the end of last year. But over that same 6-month time frame, output from all the other basins here in the U.S., so the Eagle Ford, the Niobrara, Bakken, the Anadarko Basin in the Mid-Continent, those other major oil production plays have been down, and been down collectively by about 300,000 barrels a day. And the trend lines would suggest that output from those other basins will continue falling. So while the Permian has held up pretty well and has in fact risen, these other areas are seeing lower oil production, and that means that U.S. production in aggregate has trended pretty flat. It's one of the reasons why the Q1 21 bar on that chart is a little bit shorter than the ones we saw in the fourth quarter of last year. So the production figures are it's interesting because I think another part of OPEC, the strategy of OPEC Plus has been, of course, to add barrels, its own production back into the marketplace, trying to accurately gauge how fast demand is growing. But I think their assumption as part of that strategy has been that on the U.S. side, that operators will maintain strict capital discipline, and that production, we just won't see much production growth on the oil side anyway here from the U.S. In years past, 2019 in fact saw U.S. oil output grow by more than 2 million barrels a day just that 1 year. So we're clearly not to those kind of figures yet, and I think OPEC is counting on that to be the case as it develops its production and pricing strategies for the over the short term. Now, once we get past 2023, once OPEC Plus has basically brought all its production back online, I think the question of where oil prices might go and what the strategy might be for operators is going to be of great interest. We're clearly beginning to see some countries, oil exporting countries, talk about lifting their production capacity, and I think we may hear more of those kind of stories as we get into the coming year. But for now anyway, we expect to see U.S. Oil production run fairly flat, and since so much of the gas production in the U.S. is associated gas in the form of gas production from oil wells, as oil production goes, so goes gas production. And so those figures are fairly flat as well, although we do expect to see a bit of a growth in U.S. gas output over the second half of this year. Part of that is because we'll see some new oil wells being drilled and associated gas. The other part is that we have a couple of dry gas plays, thinking about the Marcellus back in the Northeast and the Haynesville in North Louisiana, and output from those areas has begun to rise as rig count has grown. So gas production numbers are gradually returning to growth over the course of this year and perhaps next as well. So our spot price for gas, Henry Hub anyway, here in the U.S., is that we'll average around $3 per million BTU this year, up right at 50% from the $2 price that last year saw on average. The market has tightened on the gas side. It's interesting that it has tightened in that the consumption of gas in the U.S. is actually down this year. So economic activity is rising. We had some very cold weather back in the early days or the latter days of winter, and so gas consumption in residential and commercial rose because of weather issues. It's been rising in the industrial sector because of economic growth. But over in the power market, the demand for gas has fallen. In fact, it's I think projected to be down about 10 to 12% this year. And the reason for that is that as the price of gas has risen, coal, low-cost coal, and renewables have taken market share from gas. And since the power market has been the biggest single element of the gas consumer in past years, power was, I think, right at 35% of the gas consumed in the U.S. last year. So as the power market has softened, that's left the overall gas consumption figure here in the U.S. down slightly in 2021. The story is completely different when we talk about gas exports. And from the chart there, you can see that gas exports, both pipeline exports and LNG exports, are up on the order of somewhere in the 20 to 25% range this year versus last. So gas exports are clearly driving the gas market here in the U.S. this year, and will be a factor once again come 2022. So again, gas consumption domestically looks to be pretty flat next year. Exports are going to be up 4 to 5%, it would look like. So this is clearly something to keep in mind. So while we talk about Henry Hub and the domestic price of natural gas, I guess it's important for us to pay attention to, well, where do U.S. LNG prices stand, and how does that compare to the global market? So in the first quarter of this year, for example, the average price of LNG exported from the U.S. was around $6.25 per million BTU. So a decent price, much higher than the domestic consumption price, right? Interesting in the context of the global LNG market, U.S. gas has been something of a bargain. If we look right now at the price of gas sold into Northeast Asia, so think China, South Korea, Japan, some great big markets for LNG. They were paying a $9 price handle for LNG in the month of May. And so it's, again, those markets saw both an increase in economic activity and some very cold weather. And so there's been a restocking issue, there's been a demand issue, and that's been driving those markets and helped push the price of LNG higher. So U.S. LNG in terms of volume sales looks pretty good because we end up being a very economic alternative in many markets. That's why in recent months the U.S. has become the number 2 exporter of LNG in the whole world. It bumped out Australia and it now only trails the country of Qatar in terms of LNG exports. So and again, the issue of flexibility of buying LNG from the U.S. and its very economic price has helped driving the export market here in the U.S. this year and next year, and for a few more years to come. So we spend a lot of time talking about pricing as a way of trying to forecast activity. One of the things that we have also started to think about, and there's a section in the report that accompanies this forecast where we talk about carbon prices, because that's clearly becoming a factor. We've seen various business groups here in the U.S. Agitate or petition for some kind of a carbon market, trading market to emerge, because the whole notion of trying to reduce carbon emissions needs to have a price for carbon to understand the cost benefit of what your options are, whether to invest in technology that helps you eliminate or minimize CO2 emissions, or whether to change your operational practices in order to adopt a smaller carbon footprint in your businesses. All these things are conditioned upon or need a price for carbon. And so we've gathered some information about where carbon prices are today in Europe and out in California, for example, and where they might be headed going forward. So, for example, California has a carbon trading system there that is currently pricing carbon at somewhere around $175 a ton. And in Europe right now, we've seen carbon prices rise to, they have an emission trading system, ETS, and that price for carbon has now reached in US dollar terms around somewhere in the $70 to $80 range, which is about double what it was only 3 or 4 months ago. And the reason it's risen so fast is that the European Union has changed under this policy or this goal of reaching net zero carbon by 2050. They've brought forward some of their targets for emission reductions, and so it's become much more valuable to be able to have a carbon credit, as it were, and because these credits get purchased by businesses that are carbon emitters, and then they're turned in at the end of the year for to meet their allowance. And but some expect that in Europe this carbon price might exceed $120 a ton fairly soon. And longer term, there are groups that are talking about $200 a ton for carbon. The average, it has been estimated that the average oil field development project generates about 45 pounds of carbon dioxide for every barrel of oil that it produces. So if you take that price of $200 per ton of CO2 and you divide it by the $45 a barrel or so that you 45 pounds of CO2 per barrel of oil, then you end up with a carbon price that is somewhere in the $4.50 per barrel of oil range. And so one thinks about, well, what would an operator do to avoid that $4.50 surcharge, as it were, to his cost of operations? What kinds of fields would he choose to develop that would presumably be less carbon intensive? What investments might be made in terms of carbon capture and renewal, for example, that would again help minimize the CO2 emission, although dollars spent for CO2 emission would take away presumably from dollars spent for field development. So all these things I think are important for the industry to, as a group, begin to understand and track, so they begin to assess how quickly some of these changes that are being talked about with regard to trying to get to a less carbon intensive future, how fast they might happen. Because I think that the higher the price that these carbon credits go, the quicker the day comes forward that of changes in both the investment and the operation side that this industry and other industries might make, other fossil fuel using industries might make to avoid this kind of tax on their businesses. So that's something that we have added this time to our work and want to incorporate in our thinking, particularly as we consider where things might be going 5, 10, 20 years out in the future. More importantly, or more to the point in terms of short-term activity, of course, is beside the point of where our commodity price is headed, is what's going on with regard to capital spending here in the U.S. and on the particular point of the discipline around capital spending that U.S. oil companies are exhibiting and what they might continue to exhibit going forward. So to that end, we have, over the last several months, been developing a financial database, as it were, of U.S. Oil companies. And the group that we're tracking now accounts for about 30 different companies. Collectively, they drill around 35% of the wells here in the U.S., and they spend collectively somewhere between 50 and 60% of the capital dollars on drilling and completion. So it's not every operator in the U.S., but it's a very healthy sample. And so the next set of slides that I want to show you are from that data set because it gives us some insight into the issue of on the very important point of capital spending and CapEx discipline on the part of U.S. oil companies. So these are independents for the most part. We also track the majors, the multinational companies, Chevron, Shell, Exxon, and so forth. But their capital spending dollars are spread across both upstream and downstream. So that analysis is not a part of the work that I'm about to show you. But again, these are very much U.S. focused or companies, and primarily in the upstream sector. So a pretty clean picture of what is going on in North America right now. Because clearly for this group, I mean, the DNA of U.S. oil companies has been hardwired to chase higher revenues with higher spending. That has just been the case throughout my career in the oil patch, and it's only in the last couple of years that we've begun to really hear operators talk about how they want to stay disciplined in terms of spending, focus on operational efficiency, a real profitability mindset, as it were, in order to deleverage their companies and to improve their shareholder returns. So all that I think is going on, but we've got to see if they're actually staying close to that, because again, many of these senior managers grew up in an industry at a time when it was just a natural response when prices rose to begin to lift spending. It's much like the classic story from the Greek mythology, right, where Odysseus had himself strapped to the mast as he sailed past the island where the sirens were singing. He was otherwise tempted to jump overboard and swim ashore to meet them, and so we're seeing $65, $69, $70 oil prices, and yet the captains of these ships U.S. oil company ships have said, how can we stay true to our promise to sail on past this high price and instead deliver a high return to our shareholders? And so that's the challenge today. So what you see on this particular slide are the quarterly revenues of this group of companies. And the light green bars are our forecast of those revenues using oil prices of $65 and a barrel and $3 per million BTU for gas. And what you see is that over the balance of this year, last 3 quarters of the year, U.S. oil companies are going to generate somewhere between $45 and $50 billion per quarter in terms of revenues. When we think about cash flow from operations, again, the same group of companies, we believe will be generating somewhere between $16 and $17 billion per quarter of CFO. So it's a substantial improvement over where it was last year, of course. That's an easy comparison. And in line with what was the case back in 2017, 18, and 19. So we've returned to those kind of cash flow levels from years past. What's interesting then is, because again, it's not surprising to see the cash flows sort of got back to those levels, because at the $65 price, that's typical of what the prices were back in 17, 18, and 19. The interesting story is on the reinvestment side. So here's our reinvestment ratio, which is CapEx divided by that previous slide, cash flow from operation. And what you see then on the dark bars are where those numbers stood for the years 17, 18, and 19, and then by quarter for last year and by quarter for this year. And again, what we saw in Q1 anyway was that CapEx was a mere 50% of cash flow from operations. It was the lowest point on record over the time that we've been looking at these kind of financial numbers. And we think that it will continue at these low levels going forward. We have much of the second quarter in the book, so we know where rig count has been. We think we know what spend per rig looks like. When we put those numbers together, it would look to us as if this reinvestment number is going to average maybe 55% in the second quarter of the year, so not much of a change, and then going forward, a little bit better growth on the ratio side, but again, nowhere near where it stood back in 2018 and 19, and of course 2017 was a year you see where CapEx actually exceeded cash flow from operations. Operators as a group had to go to the market to find the funds in order to fund their drilling programs. So what that means in terms of the actual dollars themselves is that CapEx in Q1 of this year was around a little over $7 billion. We project that it will rise to almost $10 billion here in the second quarter, and then grow slightly from there, somewhere around $10.5 billion in the fourth quarter of this year. From a couple different ways to think about this. One is that the Q4 2021 numbers are up on the order of about 70% from what Q4 of 2020 looked like. So So that's a big, change in time. When we think about years as a whole, our projections would say that $37 billion will be spent CapEx on the part of this group of companies that we're looking at here, and that'll be up about 7% from the $34-35 billion that this group of companies spent last year. So we've seen capital spending rise, but the plowback ratio has remained at very low levels. So what's been going on instead? Well, this looks at the quarterly change in net debt from these same companies. And so what you can see, if you just concentrate on the last two bars on the chart, the ones for the fourth quarter of 2020 and the first quarter of 2021, what we see is that this group of companies collectively was retiring debt to the tune of about $4 billion a quarter. That worked out to be around 20 to 30% of their cash flow from operations in those period of time. So while plowback ratios or reinvestment ratios have been depressed and are running at 50, 55, maybe 60% of cash flow from operations, what we see is that 20 to 30% of cash flow from operations is now being used to retire debt. And that's been clearly something that many of these firms have talked about, and it's apparent that they're walking the walk as well as talking the talk when it comes to debt retirement. So we have not tried to project what those numbers might look like over the second, third, and fourth quarters of this year. So the fact that you don't see anything going on there really doesn't mean that we don't think there'll be a net retirement. My expectation would be that we'll continue to see $3 to $4 billion per quarter of debt retirement taking place over the balance of this year. And so we put all those things together. We think about continued capital discipline on the part of operators. Then our forecast of rig activity is for further gains in rig activity, but not extraordinarily sharp rise from where we are today. So again, from Q4 of last year to Q4 of this year, rig count goes up about 70%. But when we do the averages for 2021, 467 active rigs this year will be up about 7% from the count of rigs that we saw last year as well. It might be the case that rig activity would be up a little bit higher than this were it not for the fact that the Biden administration has put a temporary moratorium on permits from federal lands. And there's the impact of that can be seen if we look at the case of the Permian section of New Mexico and the Permian section of Texas. So same underlying formation, just lying in two different states. About more than half of the land in southeastern New Mexico is owned by the federal government, and so is subject to this moratorium. And what we've seen since the end of last year when the moratorium came in effect is that permitting activity for southeastern New Mexico had fallen by 70-80%. So very much what you might expect to see when as a result of a moratorium on federal lands. And rig activity in southeastern New Mexico has been very flat. It has changed very little since January. So operators there are clearly working through their backlog of permits, but rig count has stayed very flat on the Permian side, or on the New Mexico side of the Permian. What's happened in Texas? Well, Texas side of the Permian, rig count's risen by somewhere around 30% since the first of the year. So not much land in Texas is subject to this kind of federal moratorium, and so operators there have been free to get busy in response to improved cash flow and so forth. And there might have been a fact of some operators with property on one side of the border or the other have moved their spending away from New Mexico to Texas in order to take advantage of that. So, but clearly a moratorium is having an effect, and it'd be pretty clear there. And if we're not in place, then it might be that the aggregate rig count numbers that we see on this slide might be a touch higher. But the fact of the matter is that it is in place, and so activity has improved, and we think it will continue to grow, but the pace of gain, we think, through the end of the year will be fairly measured. And that story extends to new wells drilled. Again, we're seeing what we think will be a little over 12,000 new wells drilled here in the U.S. and somewhere close to 165 million feet of hole this year as well. Those figures are up about 10%. The footage figures are up about 10%. We're seeing a slight gain in terms of average well depth, and that's why footage numbers are up a little bit higher rate than are the rig or the well numbers. Frac jobs are a completely different story. Here we're seeing a tremendous increase on a percentage basis anyway in terms of frac activity. We're now forecasting, put it like this, at the current rates that we're seeing frac activity happening, we're projecting that for the year as a whole, we'll see somewhere in excess of 11,000 frac jobs in the U.S., and that's up a full 37% from the roughly 7,500 frac jobs that we saw done last year. So last year, of course, frac activity almost completely shut down in the second quarter when oil prices went negative and cash flow became, and maintaining cash reserves became imperative. And so frac activity was extraordinarily hard hit back last year, and that makes some of this year-to-year comparison so easy to, advantaged for 2021. But the other thing, we see, so some folks on a week-to-week basis are looking at frac spread counts, and what we noticed there, of course, is that you now have a ratio of about 2 drilling rigs per 1 frac spread at work, and that seems to be, that's higher than it typically is. And I suspect the reason for that is that we're seeing the inventory of drilled but uncompleted wells being drawn down. The operators have had a number of wells that were awaiting frac and then hookup, and those numbers are being addressed, and with the dollars that perhaps weren't being spent on completion last year. But the other thing too that's impacting the numbers is that frac spread productivity has risen tremendously from where it was a year ago. Again, part of this I think is due to just the difference in frac designs with simultaneous fracs and so forth going on. There's more stages being pumped per day, more wells being fracked per month, and all that's showing up in the measures we use to track the completion markets here in the U.S. But it's not, you can't draw down the uncompleted wells category forever. At some point you get to sort of an irreducible minimum, and so this, I think, we'll begin to see some of that become a factor as we get into next year as well. So the completion market looks very good this year, particularly on a relative basis, and we think we'll stay strong next year as well. But sometime over the coming year, the next 18 months maybe, I think we'll get to the point where most of our drilled but uncompleted wells that we will have dropped that number down about as low as it can be done. And at that point, then it'll be important to step up drilling activity if operators want to maintain production or even maybe grow production a little bit. That's one of the reasons why our 2022 forecast for drilling rig count here in the U.S. is up about 20% from the numbers we see this year. So if we're talking 465, 467 active rigs here in the U.S., this year, the number next year is about 20% higher. We get close to 550 or so rigs running on average in 2022, given where we think things are headed between the combination of higher oil prices, operator cash flow, and reinvestment trends. We do a quarterly survey of what's happening on the cost side of getting wells drilled and completed, D and C, and so we have actual numbers through the first quarter of this year. We saw a big jump, relatively speaking, almost a 2% increase in our index in the first quarter. However, I should point out that about 70% of that came from just two factors. One is higher OCTG prices, casing and tubing. It was about a 40% gain, as I recall. 40% of the gain, I should say, and fuel prices, so higher cost for diesel or gasoline was another roughly 30% of that Q1 jump. So we had a couple of very specific drivers for the rig count, or for cost increase in Q1. We didn't see much of an increase, if any, really, in terms of labor costs. And that's something that I think we'll begin to experience as an industry going forward. That's simply because labor market in the U.S. across the board is growing tighter, and that augurs for a higher labor prices and pass-throughs into final prices. So that, I think, is going to become more of a story as we get into the second half of this year here in the U.S. Switching over to Canada, we've materially increased our forecast for Canada. In fact, we're now thinking that north of the border we'll see an average of 113 active rigs, up almost right at 25% from last year, and then the attendant increase in terms of wells and footage drilled. The Q1 numbers in Q2, the second quarter of this year has come in really right on top of what we had been forecasting. And we're beginning to see in recent weeks what we believe is a return to the normal seasonal pattern of activity up in Canada. If we look at the bars on this chart for 2020, that shows a tremendous drop in the second quarter of last year, and then we had just a tiny increase in activity in the third quarter of last year as spending remained just squeezed tight shut because of low commodity prices. Well, typically 2019 is a more typical year where rig count rebounds pretty sharply, a much greater sort of unit growth in rig count in the third quarter. And we think we'll begin to see that happen in this year. So we've really increased our estimates of third quarter and fourth quarter rig activity in Canada. A second half of 2021 ends up being about 80% higher than the second half of last year. Again, an easy comparison because last year's numbers were so bad, but certainly a welcome improvement over where things once stood. And so this is, I think, the key thing for us to keep an eye on and understand about the Canadian market is that they are benefiting from, again, the higher commodity prices that we're seeing across the board. On the logistics side, the spring thaw is largely behind them, and so it's easier to get about and put rigs to work, and that's what we expect to see in Canada over the balance of this year. In terms of wells drilled, again, strong improvement in the second half relative to the second half of last year. Again, around 4,500 total wells drilled in Canada for this year, for 2021. And so many of the measures of activity up there are certainly moving up and to the right, as one might hope. Going to the international side of the house, we've lowered our numbers a touch internationally, not much. We had been talking about 675 rigs on average in 2021. Now we're talking about 665 rigs. So down about 12% from the average we saw last year. Again, if you think about it in terms of the change over the course of the year, then Q4 of 2021 is going to be about 16% higher than the fourth quarter of 2020. So that kind of improvement it will be positive, or that kind of comparison we think will be positive as over the balance over the course of 2021. But the year-to-year figures will be down about 12%. The biggest part of the change we've made in our forecast is specific to a single country, really, in Romania, where rig count dropped pretty sharply and really accounted for the bulk of the net change we've made in rig activity. So if you're not in Romania, our forecast has remained largely intact. One of the things we've noticed, though, and we expect, is that a number of projects in the international sector are for LNG or LNG projects, field development, LNG liquefaction plants, export facilities, and so forth. And sanctioning those projects, giving them the green light to go ahead, we think will be kind of slow, really, over the course of this year and next. And part of that is because, again, the largest LNG exporter, Qatar, has undertaken a program to increase its LNG capacity, export capacity by, I think, around 60%. And so it's been very aggressively going into the market to sign up customers, long-term customers for its gas. And I think a lot of other LNG projects that are, on the books, in the works, are kind of waiting to see how the process goes for Qatari gas before they greenlight their projects and move forward with it. So we think that some of that sanctioning work that we would like to see happening will kind of hang fire for this year and next, probably, until a clearer picture emerges of the demand for LNG trade, what the LNG trade business looks like coming out of a pandemic, with the biggest exporter, aggressively expanding its capacity. Wells drilled are going to be up, again, over the course of 2021, 6,700 wells or so, thereabouts, for the year as a whole. That number will be down about 6% compared to the total wells drilled last year, and somewhere between 50 and 55 million feet of hole. The market, I think, is sort of dividing, or this is something I think to keep in mind as you think about the international sector. So we think about multinational oil companies, the big guys, Chevron, Texaco, BP, Total, Equinor, and so forth. A lot of those companies, as they're adopting or adapting to climate change initiatives and pressure by their boards, pressure by their investors, are looking to both minimize their carbon footprint in field development. So they're looking for low emission projects. That's why gas has an advantage over oil. But even in the oil side, there are lower carbon projects than others. So really, I think for those kind of companies, oil companies, they're thinking about what some have called advantaged, others have called resilient kinds of reserves. Low emission projects that have low emissions, those that of course have low cost per barrel anyway. Short cycle has been a story for a while, and I think will continue to be ones where, how quickly do you begin to earn money back once you start spending to develop that field or those fields. So those are the kinds of projects that are going to get focused on when it comes to field development. And of course, that'll have a knock-on effect when it comes to exploration. Exploration is going to increasingly be directed toward finding those kind of advantaged reservoirs that operators might need to develop in over the next 10 to 15 years. So the story's a little bit different when we talk about national oil companies. So NOCs, many of them are sitting on a reserve that really represents the strategic value of and a strategic resource for the country as a whole. So if they're looking at forecasts that say global oil demand will fall, then they become under a lot of pressure to sort of adapt a use it or lose it mindset when it comes to developing those reserves, rather than thinking about maintaining those reserves for the next 80 to 100 years. Now it's like maybe we've got 30 or 40 years to use it, and then who knows, the oil demand may be so low that there's really not much of a value in those reserves. So it's interesting that we've seen a couple of different countries talk about increasing their productive capacity, and that's really even in the face of perhaps projections that demand might ultimately be moving lower. They want to be able to monetize those reservoirs that they're sitting on top of today. So a very different kind of pressures that these two groups that are so important to the international market, we believe, will be operating under. We look at it by region. Central and South America, which was hit so hard last year, ends up on a very good performer this year. We think rig count is on track to increase almost 20% from this region in 2021. 127 active rigs, the attendant wells drilled and footage drilled and so forth. A lot of different stories when you go at it by country by country. Argentina, as we've talked about, YPF, the state-owned company, is increasing its investment in the Vaca Muerta in order to bump up oil production from that shale play. Petrobras in Brazil has basically came out the other day and said, we're not going to change our 5-year CapEx spending plan. Well, its capital spending plan is, I think, $55 billion over the 2021 to 2025 timeframe, $11 billion a year. No growth in Petrobras oil production. Now, there might be some growth in oil production from other companies working offshore Brazil, so Equinor, Exxon, and so forth. But Petrobras itself is basically just sort of, marking time and planning to mark time for the next 4 to 5 years in its current plan. Colombia, again, we're seeing a big increase in spending in Colombia over this year. Again, it was hit very hard last year, and so as that economy opens back up, if some of the restrictions on economic activity and just being allowed to drill wells get lifted, that's bringing up activity in that country. But at the same time, we're beginning to see some impact on operations by some operators because there's been a certain amount of unrest, roadblocks, things of that nature, which are forcing operators to cut back or slow down development work, wells that they're in production with, and so forth. So that's a part of the story there. And then Mexico is one where, of course, under the previous administration, there had been a tremendous effort to bring in multinationals to work in that country, open up, reform its oil sector under this reform program. Current administration is trying to reverse much of that, sort of similar to much of what we see going on, I suppose, in Washington these days, and in terms of this administration versus the previous administration. But the thought is that the multinational companies that are working offshore Mexico right now are probably going to get their commitment wells drilled, and then that may just go away. So over the next 2 to 3 years. So it'll be something that we want to look at pretty closely when you think about what's the prospect for the sector down in Mexico. I think it'll become much more, it's always been dependent upon Pemex and Pemex spending. I think it'll become even more so over the next several years if multinationals begin to exit the scene down there. Europe is a story, like I said. Our estimates of rig activity for this year have been revised largely just because of what we see happen in terms of rig count in one country, Romania. So overall for the year, rig count's down about 10%. The offshore piece has actually stayed pretty flat. No change to what we had done relative to our March forecast. So the numbers there are basically steady eddy from last year to this year. Not much growth, but nothing further down. So, part of that I would point out here is that in Norway, we're seeing activity being boosted because last year the country passed a tax relief package that operators could take some advantage of, and that's bringing forward some work that might have been done or waiting for commission back in 2022 and 2023. So that's being brought forward, and the spending is being brought forward as well. The other reason it's being brought forward is it looks like that tax relief package won't be extended past the end of 2022. So it's again, the money's on the table now, boys. Let's see what we can get. Rig count in Africa has stopped falling. We think it's beginning to show signs that it may grow from where we are today. So we're looking at, I think, around 88 active rigs. That's down about 15% from last year, almost 700 wells, almost 6 million feet of hole. It's interesting that a couple of big operators, BP and ENI, are talking about combining their operations in both Algeria and Angola. I think ENI is the largest operator in Africa. And so it has pretty extensive operations in several different places, and it's in these talks with BP about finding ways to enhance the efficiency by combining what they're doing. So the exact form of that is, I guess, yet to be ironed out, but it's interesting that those discussions are taking place. They may be extended to other countries, or there may be other parties entering similar kind of discussions in other places. So that'll be something we want to keep an ear out for. There had been a big LNG development project that Total had planned for Mozambique, And that's now been delayed for about a year under this force majeure declaration that Total made, because were attacks by, I think, an Islamic group in an area near where these pipelines were going to come ashore and some infrastructure was going to get built. And with this kind of lack of security for their folks, they've basically, pulled a stop to what's going on there. So how fast that might be returned to activity is an open question at this point. Nigeria is finally made some changes to its production sharing contracts, and the folks at Shell are going to take advantage of that and proceed with a project that's been on the books for, I think, maybe 10 years now. Bonga Southwest looks to finally get up and running. And in Uganda, the East African Crude Oil Pipeline, EACOP, has finally been sanctioned. It's like 1,500 miles. It's going to be the world's longest heated pipeline. And once it gets built, there's going to be allowed for some field development to proceed in Uganda. And I think Total's intimately involved in both the pipeline as well as the field development side of those projects. The Mideast is, again, one that has begun to improve after hitting the low point last year when many of those rigs were idled over the second half of 2020. The word to rig contractors was that the idlement was only temporary. You would see those rigs being put back to work. Well, a few of them have begun to return to active status, but certainly not all of them yet. And in fact, it's interesting that Saudi Arabia just recently came out with an announcement that said that it would be spending somewhere on the order of around $35 billion in 2021. It had planned, or it had been telling investors that it would be spending somewhere between $40 and $45 billion. So that represents about a 20% cut to its planned CapEx. Previously, the thought had been, well, they might trim CapEx by 10% or so. This is a little bit more aggressive a cut to capital spending than folks had been expecting to hear from Aramco. But at the same time, the company is talking about that it's planning on lifting its production capacity from 12 million barrels a day at present to around 13 million barrels a day. I don't think there's a timetable for that yet. Currently, the company has been producing around 7 million barrels a day in recent months, so it's beginning to increase its output, but it's nowhere near reaching full capacity. So it's just interesting that it wants to talk about lifting capacity. And again, I think it goes back to that mindset that says, we got a lot of reserves, let's monetize them as best we can earlier than maybe what we had been talking about before. And then finally, there's Asia Pacific in this quick tour of the international market. Again, rig count is year-to-year numbers anyway, look to be down about 12%. But again, here's another area where we think that over the course of 2021, we'll see rig count improve as operator spending begins to be released, and we see that translate into more rigs and more wells drilled. So, and again, there's another story here in Australia coming from Santos and ENI talking about teaming up so they can share some offshore infrastructure, which might then support additional field development work. So it's not just about a cost savings kind of thing, it's about really then being able to justify additional field development projects at some point down the road. India is the single largest driller in the Asia-Pacific market. It's always tended to hire offshore jackups rather than buy its own, but ONGC, the state-owned oil company, is looking at maybe acquiring some jackups. Market prices for jackups is pretty low these days, and so it may be buying some rigs to, again, work on its own going forward. And finally, in the country of Malaysia, the country's had a depletion policy that has sort of restricted activity. That policy has been lifted or suspended, and now Petronas thinks that by doing so, that output might increase by on the order of a couple 100,000 barrels a day as more projects go forward in terms of field development work. So kind of interesting to see how all that will play out, but as it certainly would be an important factor for the market out in Malaysia. And then the other countries we talk about or we follow, of course, are China, Russia, and then the group of countries that fall in our Central Asia region. China is one where upstream capex on the part of the three big national oil companies, CNP, Sinopec, and China National Offshore, collectively are going to increase their upstream capex now by 4% in 2021. So that's maybe 1 to 2% increase in terms of rigs and wells drilled and things like that, in line with what we had previously been expecting. All these companies are making a big boost into renewables in terms of their spending programs and so forth. But in addition to that, the plan is, or the hope is, that they would lift, the country would see shale gas production grow from 20 billion cubic meters, which it reached last year, to more than double, 50 to 80 billion cubic meters by 2025. This is a challenge for the Chinese because their shale reserves are at much deeper points and higher cost to get at than what we find here in the U.S., for example. But that becomes an important supply factor as the country at least makes efforts to reduce its carbon footprint going forward and use gas in place of coal in power and industry. So Russia, another large individual player, has no plans. Its oil ministry recently came out and said it really had no plans to boost output from where it is today through the end of this decade. So an interesting fact of life. The government has responded, I believe, to the fact that frack activity fell 25% last year. So again, last year saw Russia, as part of OPEC Plus, reduce its output in order to try and balance the market and support oil prices. And without the need to produce and the ability to sell as much oil, operators slowed down their field development work, and frack activity fell pretty sharply. Again, this is very similar, right, to what we saw in the second quarter of last year here in the U.S., where frack activity dropped a lot faster than did rig activity. So frack activity down, though, about 25% last year. The government has now come out and said it will consider new measures to boost investment in what it calls unconventional oil. So these are probably going to be tax relief or some kind of tax advantaged programs that encourage operators to add to their investment in unconventional oil field development. So something that perhaps will lift activity going forward in that particular market. And finally, Central Asia, which is our countries of Azerbaijan, Kazakhstan, Turkmenistan, Uzbekistan. But in this case, we've looked at a couple of other countries that fall in this region for us anyway, that sort of get a lot less attention, the Ukraine and Georgia. So we have a couple of outside groups, PGNiG, which is a Polish company, has begun to take exploration acreage positions in the Ukraine, and expects to spin the bid in that country in short order. And the company OMV Petrom is doing the same in both the Ukraine and in Georgia. Georgia, it's working offshore. I think the same is in the case in the Ukraine. So again, looking at acquiring exploration acreage with the intent of trying to line up additional reserves to put on their balance sheets. So the main players, the main multinational players that you see in Central Asia, BP, Total, the projects in Kazakhstan and so forth, are all moving ahead with their planned field development, and we expect to see those projects sort of move on as expected over the coming year. And so that wraps up what my prepared remarks are for our presentation this morning. And what we'll do is take a break here for just a little bit so that we can reposition ourselves around the room, and then take any questions that folks might have had sent either into Richard or typed in the chat box while I've been talking, and so we can get your questions either on matters that I've spoken to or ones I may not have addressed. Happy to talk about either one today. So thanks so much for being part of our morning today. And let's see those questions now. And now we go. Yeah.
We'll now
Tell me when we're live.
Okay, we're live? All right. I think we are back live again, my brother. And
Good.
Here we are. So you would not have known this
No.
while you were talking, but the price of oil during that last hour and a half
Yes.
is knocking on the door of $70 a barrel.
Yes. Current delivery, I believe. I think that's
Well,
right.
yeah.
Longer term, I think we're talking, 62, 63. It goes. The market's expecting the next couple of months to be tight, and then it goes down a little bit. So, but
Yeah.
that's startling, isn't it? Yes.
But the thing that I notice is that
Yeah.
it is now moving in big, bold steps, and so the market, the global awareness of the situation of oil is catching up with us.
Well, I think that's right. Yeah, I think that nothing like folks moving around, driving their cars, rising gasoline demand. That's just that's wind at the back of the sails.
Also, you would not have known this, but at the start of your talk, we had a bit of a technical link issue.
Oh,
But since we record this
Yes.
event, if you're watching it at this point, you clearly have the link. And so if you missed the first part of our talk for the first 10 minutes,
Yeah.
it's right there. As soon as we go, there's what's the opposite of live? Dead. As soon as we're done, this will be reposted, and somebody can stream the whole thing at their leisure for a while.
Yes, for a while, being several weeks.
All right. So,
Okay.
So we had a few questions that came in,
Yeah.
and by the way, I think you may be the only guy in the oil and gas industry today who will have used the Greek mythological term, the Odysseus tied to the mast reference.
Yeah, there you go.
But it was pretty good
Mhm.
because it talked about the constraint of folks.
Yeah.
You brought up that you are now relying heavily on the cash flow of oil companies to do your forecast, certainly for the United
US,
States
yes.
part of it.
Mhm.
And we always used to know that, in the past you had, whatever it is, 700 data series that you followed.
Right.
Sunspot activity was always my favorite one back in the natural gas drilling days. But how much weight do you think you put today on the whole cash flow forecast, or the cash flow part,
Right.
to drive your forecast? And what would cause that to change?
Right. That's a good point. Over the near term, anyway, over the next, thinking about the balance this year, next year, and so forth, I think the priority has to be considering the cash flow pattern of U.S. operators. So of the group that we're looking at, to give us a sense of what the U.S. picture will be. So beyond a couple of years, then you have to go back to sort of the fundamentals of where are oil prices going, where demand's going. I mean, they're just that's what I would fall back on in terms of thinking about longer term activity levels. But short term, in particular, because I think operators in the U.S. are feeling their way forward with regard to, like, what is the right level of reinvestment, and how long will we have to pay down debt to get our capital structure to the point where we and investors are comfortable with it, that kind of thing. So all that is, being decided, in real time.
Yeah.
And I think we just have to focus on that, because clearly operator behavior and capital spending decisions are a function of those problems that are immediately ahead of them. So that's where I would focus, like I said, for the next couple of years. I think beyond that, my gut tells me that
The next couple of years.
Yeah, I
So
think so.
all of this year.
Yeah, and
all of next year.
Yeah. I think beyond that point, we may be getting to the point where operators can begin to say, okay, now we can go to what we think is sort of a steady state level of reinvestment. So instead of the 50% plowback rates that we see right now, maybe our long-term rate's 70%, maybe it's 80%, but it's I think we'll have to wait a couple years to get to that point. So in the meantime, the cash flow numbers become paramount.
We had a client post a question, and it was phrased correctly, so I'm going to rephrase it just
okay.
because I got to have a job here.
Sure.
But you've got, in your forecast, you've got rig count rising.
Yes.
you've got frac spread activity rising, but we've got oil output flat. And so is this the evidence that we have that we're on this treadmill that the unconventional plays have that we've put ourselves on with unconventional plays, where we drill and we drill more and we frack and we frack more, but that isn't enough to raise the output.
Yeah, absolutely. That's something we've talked about and tried to get a feel for as to how much activity is needed if we wanted to hold output flat, and so we're getting a sense of, right now you have to frack about 11,000 wells a year, and that's what's needed to hold output steady for oil and gas. And depending upon how fast the productivity of new wells falls going forward, that will affect how fast the hamster wheel has to spin. Maybe we have to get to 12,000 wells fracked a year in order to hold output steady. So yeah, that's the issue right now. We have to remember that back in 2019, 2018, we were fracking, completing over 15,000 wells a year. So we're doing 11,000 now and we're holding output steady. Back then we were doing 15, maybe 16,000 wells a year, and output was rising. So
the wells themselves are not fundamentally different. 10, 11,000 foot laterals, number of frac stages is about the same in a wellbore that looks like that.
Right.
And so there's nothing about the mechanical part of that rock.
That's right.
Which has changed.
That's right.
So that's not a variable that's changed.
No.
It's how fast are we doing it. So one of the things that we brought then up is there, can you draw down ducks forever? And is there an irreducible number?
Right.
Is there an irreducible level of drilled but uncompleted wells that you can just never get below? Of course, that is true, right?
Yeah.
I mean, there is a number that's irreducible.
And so how do you estimate what that number is? If we look today at the reported number of ducks that the EIA has, it's around 6,800, 6,900. A year ago, it was 8,800, right? So over the course of the past 12 months, we've seen that duck number drop by 2,000 wells. And so how did we get to 8,800 ducks in inventory, right? I think the one way to think about that is, okay, we were running roughly 800 rigs on average back then. Those rigs were completing 2 wells a month, drilling 2 wells a month, say. So you were drilling 1,600 wells a month. And back then, anyway, it was not uncommon for, we saw data that would suggest that operators were probably 5 months on average between the time they were drilling wells and when they were fracking wells. There was a great gap between the end of drilling and the start of fracking. So you take 1,600 wells a month being drilled and you're waiting 5 months before you start fracking them. You've got 5 times 1,600, 8,000 wells sitting around, right? These days, we're running, let's say, 500 rigs. Rig productivity's gone up. We're drilling 2.5 wells a month. So 500 rigs times 2.5 wells. That's 1,250 wells, new wells per month. The gap, that irreducible gap, right, so we're certainly seeing the time between drilling and fracking shorten.
So it's not 5 months, but maybe it's 2 or 3.
It may today. I think that it could possibly get to be as low as a month and a half, or maybe 2. So now you take, say, 2 months, a gap, 2 times
2
times 1,250.
Times 1,250.
So now you're around to 1,250 wells that might. I'm sorry, 2,500 wells.
2,500.
Yeah, that might be in inventory at any one time, awaiting frac jobs.
At today's drilling level.
At today's drilling, right, at that 500 rig level. And so if we grow rig activity beyond where we are today, then that duck number would increase. That irreducible figure would continue to, would grow. But So we're at, what did I say, 6,800 or so ducks in inventory. That irreducible figure is 2,500.
You know what? I think it's bigger than 2,500 because because we're taught that was almost a perfect situation.
Oh, yeah.
And nobody in the oil industry is perfect.
Okay, so why has there been that gap? Well, it has taken a while for operators to get that production infrastructure in place, not just the stuff at the well site, tanks, storage tanks, and heaters, treaters, and all the rest of that stuff, but also the flow lines. If you're a if you've got associated gas production, and you don't want to flare, then it takes a while to get those gathering systems in place. And so that's been one of the reasons. That's been the big reason why it's been taken so long between drilling and fracking. And as activity has fallen, I think it's the industry's been able to it just hasn't been log jammed, and that production infrastructure piece has been able to move faster. But you're right. Let's say it's that in a perfect world, it's 3 months of gap between drilling and fracking. So you're somewhere in the 3,500 well range. So that would suggest from where we are today, then you could go for probably another year and a half, stretch it,
Drawing down
ducks before you get to that point where you've sort of touched bottom.
What we're seeing is this confluence of events that's happening, that's going to happen sometime in 2022.
Yes.
And it's where we run out of the drilled and completed well, so we can go grab and frack and put that well in production. So we run that down to its minimum. We've got drilling activity that's trying to rise because the price of oil is significantly higher, and yet no way to fund it with external capital.
Right.
Because I'm still paying the debts of the past. And I'm confronted with a very interesting situation as an oil and gas producer in the United States.
Yes.
Which is I need to do more. The world wants me to do more.
Right.
It's sending me the price signal to do more.
Yeah.
That's when I switch. So I'm going to go mid-summer 2022. What were you going to say?
Well, I was about to say, that just depends upon how tightly those managements are tied to the mast of the ship. And
We're back to Odysseus. Yeah, baby.
Was there another question?
Yes. Let's see. Drilling at 20% due.
Yeah.
Okay, you got that one, Duck Exotic. So here's the international one.
Yeah.
And it's our friends at Valiant who send this. And it's the issue of environmental scrutiny, very much here in the United States, very much in Europe,
Yes.
and spreading on a global basis. So if that's the case, already talking about air-related environmental issues, does it then spread to water-related environmental scrutiny, and does that have an impact on the produced water? Because pretty much every oil well produces water.
Yes.
And so does that water and its handling, does something happen that causes that to be a constrained event, which would cause oil production internationally to...
So will those U.S., North American, European standards regarding disposal of produced fluids, produced water, be extended to the rest of the world?
Can we just say the Middle East? Will it? Does it even have any impact on activity in the Middle East?
I suppose we could look to the drilling fluids market, where clearly over time we've seen some, what's the right word, uptake of international standards around disposal of drilling fluids, and that's being applied maybe sometimes just in the margin, but so it does happen, and it does affect how companies operate. The sequence would be that multinational firms who have to answer to a broad constituency are probably the ones who have the tightest environmental standards around everything that they do, but including disposal of produced fluids. And then it works its way into more local or the national companies that are there. So I think it does happen. The question, of course, will be like, what form does it take? In the U.S., we used to be able to let produced water run off into creeks and, surface discharge, I think is what they called it. But now we can't. I mean, they're injected and so forth. There's some evaporation, I guess, that takes place out west. So what form will that be? So I think that will will be happening, and it may have some impact in terms of how production operations internationally get conducted. Yeah.
But if you think about where the big oil production comes from,
Yep.
Brazil, the Middle East, Russia,
Yeah.
China's got their own issues.
Mm-hmm.
The environmental impacts
Right.
tends to be minimized at that point.
Yeah.
So I think it's a long time coming.
Right. Yeah. Exactly so. And you've got some pretty, in some of those countries, you have very strong sort of central oil ministry, industry regulators who march to their own beat. So yeah.
I would like to have the oil more than I would like to have the environment.
Yeah. That's right. Yeah.
So you just deal with that.
Yeah.
Like, I think that's all the questions we've got. By the way, if you're watching this on the video, I'm drinking out of my Helmerich and Payne cup, and it's not necessarily an advertisement for Helmerich and Payne, but this is advice and suggestion for the entire industry. Yesterday, H&P was very gracious in opening up their global control room operation. They run 150 rigs from this control room in Tulsa. And they were very gracious in opening up that control room so that my wife and I could bring about 15 high school and early college kids up to see what this job is in the oil and gas business. And these were kids who would not necessarily have ever thought about where does oil come from. But in seeing this technology applied to drilling a hole in the ground, it allowed them to see this is the oil industry, this is what you can be if you've got get a college degree or just have a lot of grit and determination and grow yourself up. In the process, I got this really great cup, but they were wonderful hosts that took an hour out of their time to show these kids how this job worked. Yeah. And so my challenge to everybody on here is everybody watching has some sort of company, some sort of a thing that they can show other folks. And I would hope that each of us would open up our companies to show a 16, 17, 18, 19-year-old what it is that this industry does, because it is the coolest applied technology out there. We might be a little too familiar with it, so it doesn't look so cool. But if shown properly, then you've got the next generation who's interested in it. So again, thanks to Helmerich and Payne and their cup for hosting that. But I think that's about all we've got.
Yeah, the only thing I want to add is that we'll be back here in September refreshing our forecast, but always happy to take any questions between now and then that folks might have about where we think drilling's going or what is happening to oil and gas prices. So don't be shy. We welcome any inquiries folks might have to give us a call or drop us a line. We'll try and be responsive. So.
And can we suggest this? I mean, we were always in person for 30 years.
Yeah.
You want to try to do it in person in Houston again in December?
We'll test the waters. We'll see how anxious and capable folks are, because I think a lot of companies have to are being cautious about bringing folks back together again, and we can't get too far ahead of it.
No, we can't get ahead of their skis.
Exactly. Anyway, hope to see you soon, though. That's right. So thanks so much. We'll be in touch.